Yo, comrades, welcome to the channel. It is Maleki, the growth and dividend growth investor. Got a couple different topics I want to talk about. One of the first topics I want to talk about is my total portfolio value. And then I want to talk about the three different investing strategies that I'm implementing, which the three are growth investing, dividend investing, and then index investing. So just kind of going to show like a comparison between the different styles of investing. And then I will be going over my portfolio, different things that I have been doing in this like uncertain economic environment, as well as the different changes I have in my dividend growth portfolio as well. And then we'll talk about my dividend income spreadsheet. So let's just talk about the overall portfolio as a whole. So currently right now I have $144,086. 46 grand in my 401k, 14 grand in my Roth, and then $83,000 in my growth account. So basically almost 42% of my holdings are in tax advantage accounts. So 401k and then a Roth IRA, and then the other 57% is in my growth holdings. So for the most part, like compared to my last video, I believe my total portfolio value is $141,000. This one's $144,000. What has seemed to have helped is my 401k kind of bolstered up a little bit, and then same with my Roth IRA. My growth holdings actually decreased compared to my last video, but these two have came up to allow me to have like a month-over-month increase. It seems like that with the uncertain economy, with the COVID cases going up, the last month the stock market was down, but it seems like there is a new hope with like the vaccine, as well as we know who the president is. So the uncertainty is kind of decreasing, and now it is the market is more poised to have an uptrend. You know, there's still some negative catalysts with the COVID cases increasing and talks about shutting down economy again. But as of right now, it seems like the economy or the stocks are doing okay. It seems like my portfolio is doing okay, and I'm just kind of showing you guys so maybe you guys can compare your portfolio to mine and how it's faring in this this economic environment. Even though, you know, it's interesting what the holdings are doing, one of the most important things is the actual strategy associated with investing. So, you know, a lot of people are saying, oh, you know, with the uncertainty, you should be more in cash and sitting on the sidelines. But here's the thing, though, there's no point of being in cash, and there's a couple of reasons that I think you shouldn't be in cash and you should be investing. If you look at research, the best style of investing is, say like you had every single dollar you wanted to invest in the future and you had it in one lump sum. If you invested one lump sum in the beginning, that has proven to be the highest return that you can get if you were never to invest any more money. Now, that's the best way. Lump sum investing is the best way. The next best way is to dollar cost average. Not everyone is going to have the one lump sum of everything they want to ever invest in. So in the meantime, what normal people can do is cut dollar cost average and keep putting money into the market. And that is a very effective way to build wealth. And it actually is one of the top ways to build wealth. You know, dollar cost averaging allows you to buy shares. It kind of averages out the price. So then, like, you know, when you're buying here and here and here and here, and then the stock price increases, you're continually getting gains. Whereas, like, you know, if you're trying to time the market, there's a possibility you could time it at the wrong time and your gains won't be that good. Whereas, like, with dollar cost averaging, it takes out the uncertainty and just buys it in all environments. When it's flatlining, when it's decreasing, when it's increasing, it allows you to build wealth over time. And honestly, like, that's really one of the best ways to do it. Like, you know, if you look at my account, continually putting the money in. Like, if there's a couple principles that you need to do to build wealth, it is to put money in over time. And I'm one of the guys where I like to practice what I preach. I'm not going to be sitting here telling you what to do if I'm not doing it myself. That just makes no sense. So every single Monday, I invest $125 into my growth account. As you can see here, every single Monday, there's something in there. If there's anything left over, so like in the month of October, this is an October update video, I was able to put in some extra tidbits of money. So I think on top of the $500 I already put in, I put in almost an extra $500 as on top of the 500 I put in. So it seems like, I'm adding a little bit more cash in there. And anytime I have extra money, like it seems this paycheck, I didn't have too much left over because we had a lot of expenses in September or October. But, it seems like things are cooling down and I was able to put a little bit more money in November. The key, like you gotta keep dollar cost averaging. Like that is one of the top ways to build wealth. If you had the mentality of a lot of these people with weak psychologies where, for example, like let's look at my 1 week chart. If I looked at my 1 week chart, oh my God, the stock market is down 3,000. My holdings are down $3,600. I need to pull my money out. Like, what am I gonna do? Like, oh my God, like somebody, like I need to pull all my money out, be in cash. No, that is not what you're supposed to do. It's not about timing the market. It's about time in the market. You have to stay inside the market. Look, even in the 1 month, like, dude, if I sold my shares, I would have lost $6,000 just from this month. But if you look at the long term, again, I'm dollar cost averaging. I'm buying, still buying, still buying, still buying. And ultimately, over the long term, you get a nice gain. That is the power of dollar cost averaging. And that's why you have to continually do it. Like one of my the biggest things I want to kind of get across is like I may not be the best person like picking the actual holdings or like how to evaluate companies. Like there are much better people at doing that. But what I am really good at is sticking to a strategy, sticking to a couple different strategies and sticking with it and seeing how it turns out. Like I may not be like perfect individually picking, but my overall strategies is what is effective. If you have an overall good strategy, like as a whole, like the macro strategy, well then the micro parts will fit in, like picking the stocks and that stuff. Like the most important thing that I want to get across is like your overall strategy to put money in. Like if you're not putting anything money in, or like you're not like committed to putting like $100 away each month, $500 each month, you're not going to succeed. You need to have a set amount, and then if you have anything over, you could also add that in there. But let's just go over how my holdings are doing. So 2 holdings, cost basis 54,000. Now this is not the actual amount of money that I put in. I used to own the triple Q, but then I sold it to buy more shares of these two. So really my cost basis is like more so like $43,000. But because I sold triple Q, it increased my cost basis. But I mean, it doesn't matter because I mean, if you look at year over year, I've been investing for 2 years now. So my return would be about 25% every single year. So that is an incredible return year over year. So this is the power of growth investing. Now I want to switch over to my dividend growth investing, and this is the account I'm actually a little bit more excited about. Like the future of Tesla is huge. I love the investment managers at ARK Innovation, but this is one of the cool parts that I've been like studying and trying to learn is dividend growth investing. So overall, my dividend growth portfolio, I've invested $12,000 total dollars. This is the portfolio value, and this is how much dividends I've gotten paid all time. So all time in this account, last 2 years, I've been paid out $373.23. In my portfolio, I used to have one more sector here, and it was materials. And what I decided to do, and it was a 10% allocation, what I decided to do with that is take that 10% allocation and add it to real estate, because my level of competence in real estate is much higher than it is in the materials section. In the materials section, I did own companies that I was very confident about that were going to succeed, but I believe that certain ones could be disrupted. So what I really want to do is like I want to invest in real estate, and in the real estate sector, I wanted to focus on companies that really cannot be disrupted. So I'm just going to go over each sector just because I made a lot of changes. I used to own 46 holdings. Now I'm down to 37. My total yield is 3.7% with an expense ratio of 0.1. So my actual dividend yield is about 3.6%. So if you look at this portfolio, the main theme of this is specialized REITs. I own cell phone tower REITs. I own data center REITs. The majority of all of these holdings are either that. I own one residential real estate company. I own one medical real estate company, and then one industrial. Everything else here is specialized REITs that are more so with technology. And I believe the companies that I own are in a poised position to benefit off the 5G future as well as the cloud infrastructure. In terms of financial, I didn't make any changes here. I don't believe any of these companies in this section will be disrupted that much. I believe that JP Morgan, Bank of America are eventually going to start closing down. With the advent of the whole COVID, I think what it did is accelerated the brick and mortar closures and switched more over to fintech. So I believe that these two companies, even though they have a huge brick and mortar presence, I believe that they're in a good position to be able to switch to more of a digitalized online wallet. Brookfield Asset Management is like a alternative asset manager, and I believe they do good business. Visa is a tech company, I do know that, but I feel like I would have been able to own more shares of Visa if I put them in the financial section, and the Main Street Capital is like a business development company. So those are my holdings, and I wanted to own quality companies versus a whole bunch of other companies. So what I want to do is I want to just focus on the good companies. In this section, in the communication section, I have Disney and AT&T. I used to own Verizon, but the reason I don't own Verizon is because they don't have a streaming service. I believe in the communication sector that if you have a streaming service, you are in a position to be an innovative company and you are in a position to succeed for the future. I know Disney has stopped paying their dividend. They suspended their dividend, but I believe with the $3 billion they're saving, not paying the dividend, they'll allow themselves to put themselves in position to benefit off the streaming. So their Disney Plus platform is pretty solid. And then for AT&T, the HBO Max that they own, I believe that it has a great future, especially with all the subscriptions that they have with the cell phone service. And I can see how they could tie the HBO Max with that subscription service. So I feel like they're in a good position to benefit off it, as well as the aggressive stances they're using to pay down their debt and get rid of non-essential businesses. So I believe that these two companies are in a great position to succeed. And I believe AT&T is extraordinarily undervalued right now and pays a really nice yield. I'm not going to have too many comments on the healthcare sector, especially like I do work in healthcare, but to be honest, I don't really know how a lot of these companies make money, especially with if the US has more of like a one type payer healthcare system. I don't know what that means to these companies. So for the most part, I just own the highest market cap companies, and that's all I'm really going to comment on that. I don't really know too much about those sectors. In terms of utilities, what I wanted to do is I wanted to focus on utilities that are leaning more towards renewable energy. Next Era Energy is one of the world's largest renewable energy companies, and so is Brookfield Renewable Partners. So these two companies are in a great position to succeed, especially with us switching over from coal burning power plants to switching to more like wind and renewable and nuclear energy. And these two companies are the companies I want to own. I used to own Duke, Dominion, and Brookfield Infrastructure, but a lot of those assets had gas pipelines, and I do believe that in the future those will be disrupted, and I just want to own these companies while they're cheap before they start exploding. So I believe that having a focus towards like renewables is the way to go, and especially I believe like 25% of the United States energy is produced from renewable energy. Industrials, the trend for the industrials that I want to do is there's like two things. I want it to benefit off of e-commerce as like services, have like industrial products, and then a service that you need to have. Waste management, you need to have your garbage picked up. Like we're going to have trash, and there's going to be somebody that needs to pick it up. Waste management is a company that is in a great position to continually gain market share. 3M, I was just remodeling my bathroom, and I used a lot of 3M products. I also work in healthcare too, so the 3M face masks are pretty solid. So I do like that company. So like I'd actually see the products that I'm using. I've been seeing a lot of FedEx and UPS trucks, and to me, with the trends of brick and mortar stores closing, I believe that a lot more products are going to have to be shipped. So I believe that UPS, FedEx, and Old Dominion Freight Lines are companies that can benefit off of the trend of closing brick and mortar and switching over to e-commerce, because all these products at the end of the day need to be moved, and these companies move products. My income play, so this income play here, it has 11% yield, almost a 1% expense ratio. So basically it's a 10% yield, and what this does is it sells options. They sell covered call options. So what it does is every single month they pay income. So they pay about a 10% after expenses income, and to me, I want to use that to bolster up some cash flow, so that whatever cash flow I can get from this, I could reinvest into some of these growth plays that I have over here. In terms of consumer, I used to own a couple different other companies, and what I want to do is I want to switch from like a lot of individual products more so to what direction like some of the markets are going. Let's talk about Walmart. Walmart is still one of the highest revenue generating companies on the planet, and I still believe they're in a growth phase because what they're trying to do is they're trying to compete with Amazon Prime with the Walmart Plus, and I believe that with the amount of cash that they have, they could really put a dent into the Amazon Prime service. And especially they got a lot of smart people working over there. They're going to try soaking up some of Amazon's market share, and a lot of people are getting this service. In terms of Procter & Gamble, they make great products. I mean, I love the Old Spice deodorant line that they have, as well as some other um, toiletries and stuff. So like this is just a company you have to have in your portfolio. Home Depot, like I said, I was remodeling my bathroom. Like the place, like as a man, you can spend cash there. Like let me tell you that. And Nike, I just love the brand, and I believe that I believe Nike and Walmart are really good growth plays. Even though Walmart is still very established, I still think that has a lot of room to grow. And finally, information technology. I used to own Broadcom and IBM. I got rid of them. Everyone knows Apple is one of the best information technology companies you could own. No comment here. Microsoft, I like what they're doing in their cloud space, and the fact that they have the immense amount of cash reserves. I believe that it positions them in a great spot for machine learning, AI, cloud computing, cloud infrastructure. So I believe Microsoft is still the best. Qualcomm is going to be benefiting off the 5G revolution. They produce the semiconductors for all the cell phones, so they are taking a huge market share. And then Intel has been shit in the bed lately, but it doesn't matter because this is my contrarian play, and I believe that some of the delays that they have are okay. Things get delayed, but as long as they produce great products, they still are a great cash flowing company. So that's my Roth portfolio as a whole. So I just want to tell you guys that, for the most part, um, like this is kind of what I have in terms of, let's see, the winners and losers. So basically Qualcomm, Apple, Microsoft are the top three. So information technology seems like JP Morgan. So we're doing pretty good over here. And the top three losers over here: Iron Mountain, Intel, and DLR. For some reason, the real estate investment trusts are still taking the beating. So as you can see here, the majority of my holdings, Prologis, Cone, or CyrusOne, DLR, and Iron Mountain, all real estate investment trusts are still taking a beating, but that is okay because we're just, whatever dividends we get paid out, we'll just buy cheaper shares. In terms of funding history, I only have $6,000 last year, $6,000 this year, $12,000 total. So there's not much else I could really do over here. So let's talk about my dividend income. So the last thing I'm going to talk about is my dividend income spreadsheet. Total invested, like I said, is $12,000. For the last month of October, we had $29.28 in dividend payments, so that puts our total at $282.41. Average monthly income is $35.30, so that puts us at a dividend yield of 2.3%. So we still have 2 more months where this could increase, and the script that I ran was this number divided by this number gave me this number. So even a 2.3% yield is not that bad, but I believe, we should be having a pretty higher payout for one of these next months just because the quarter is over, and I think majority of the companies pay out so remember on this time in September they paid a huge amount. I believe one of the times it should be a little higher up here, at least maybe between 50 and 75. It'd be a little disappointing if it was under 50, but that is okay. And again, this account is in its infancy, so we would like to see where it's going. I was saying in the other videos, like as long as I see growth from the same month of this year compared to the next year. So if I have $29.28 this year, then in October 2021, I better see something above $29. And then same thing with 2022. So I already have these two set up just so that when the time comes, we could showcase how each individual year, and over time, we'll keep adding the years and see how it goes. And ideally, I would like to be cash flowing 10 grand a month. So we're a long way from there, but just want to show you guys my portfolio. And just one last final word. The most important thing to investing is it's just putting your money in and not necessarily touching it. The more you touch it, the worse it is. You put your money in, have a good strategy. I have 3 different strategies. with investing, I have like index investing, dividend investing, and growth investing. You don't have to do all three. You can just pick a strategy that's the best for you. I just want you guys to build wealth over time. Like, that's one of my goals. Like, I want all of us to get the piece of the pie out of this life. And I believe in doing so, like, you need to set yourself up well. So whether you're a growth investor, a dividend investor, or an index investor, like, this is all information that we could be learning from each other. And like, to we'll see, compare and contrast. Like, like, is this better to own because, like, what, like, you don't see much fluctuations compared to this one where you see drastic volatility. It really depends. Or are you just a cash flow investor where you just want to see that monthly cash flow go up? Like, to me, I couldn't just sit on the sideline and pick one. I wanted to do all three, so I am doing all three. So we'll see how this portfolio grows, and hopefully, you guys can grow your portfolios too. And it'd be interesting to see how this thing goes. All right. Well, guys, thanks for watching the video. Appreciate it. And if you can, like, comment, or subscribe, it would really mean a lot to me. And you guys have a great day.